Hey everyone, and welcome to the EcoInvestment update for June 12th, 2016. And I hope everybody's having a good, well, we're almost into summertime now, so a good pre-summertime season. I was really struck last week in the, I watched the markets quite a bit on a daily basis, and I was really struck by the fact that interest rates worldwide on average are the lowest that they've been in 500 years of recorded history. Let me say that. Interest rates on average around the world are lower in total than they have been in 500 years, which is probably as far back as records go for the rate of interest that was generally charged maybe from one government body to another, or to maybe a lending institution from government. Just let that sink in though. 500 years. Now the thing that concerns me about that type of announcement is that there's so much debt out there. There was so much borrowing that's occurred over the last particularly 50 years, not just in the United States, but also in Japan and many countries around the world. There's so much total aggregate debt that it just seems shocking to me that in the face of what you call a debt explosion, that we could have the lowest interest rates in, well, recorded history. So once again, it shows you if economics and investing and predicting the future is something that you hold dear and something that's important to you in terms of your analysis and where you're going to make money, then you have to be distressed when something as logical as too much debt equals the lowest interest rates in world history. It just doesn't make sense. With that level of debt to be funded and continuously rolled over and reinvested or re-upped at new rates, you think that interest rates would be shooting through the roof. This is the caution I want to give you now. Interest rates at historical lows, and I do mean historical now, are not going to last forever. Which means if you have investment mutual funds that are holding long-term and medium-term bonds, which I defined as, well, corporate and general and bank and government obligations of more than about 5 years in maturity, you may want to liquidate them now while the values are at their highs. Start liquidating them and moving your money shorter term. It's not a time to be taking on risk. It's not a time to be sucking up US 10-year notes to get a paltry 1.65% interest rate. Okay? It doesn't make sense. 10 years from now, you could be at 18, 22% interest rates, and when you need that money to retire, you could be absolutely decimated by losing 90% of the value of your fund. Be smart. Recognize that a trend that's been in place since 1980 of declining interest rates is not going to last forever, and you don't want to be on the wrong side of that when that reverses, because the results could be catastrophic, and then you'll really see the debt explosion unfold, and you'll see the economies all grind to a halt. Now, in the meantime, I want to also give you another caution when we discuss people that hold pensions, people that have money in mutual funds. Remember, every year you're paying what's called a management fee. And over the life of the average investment fund for retirement, the fees can range 1 to 2% per year. Now think about that. The investment managers get their sure money. They're not taking any risk at all. They're going to get 1 or 2%. Whatever the management fee is, the money of the assets and money that they hold, they're going to get their cut. But you, on the other hand, have to take off 1 to 2% of your fund per year to give them. So what you want to understand is that at the end of 20 years in a 1 or 2% mutual fund management fee structure, you're going to be giving up 30 to 50% of the return to management fees. How do you like that? be smart, guys. Get into things like index funds that are unmanaged. They just match the S&P, the Dow, the Russell 2000, the Wilshire 5000, and stay away from the actively managed funds. Okay, those passively managed, like Vanguard funds, the index funds, the S&P 500, all they do is just hold the S&P 500 stocks. They don't have to buy and they don't have to sell, and they only have to do that in terms of redeeming or taking new money in to buy. So they have extremely low management fees, 0.08, 0.15%, 0.25%. Over the long run, if you don't want to leave a lot of your money on the floor, well, think about where it's held. Think about getting out of long-term debt, bringing stuff short-term. Sure, the returns suck even worse on the short-term, but it's better than putting your money at tremendous risk here. In the meantime, the bubble goes on, and you can tell that buoyancy also in the precious metals. Historic low interest rates, beware of management fees. Take care of yourselves, guys. I'll see you in a week or two. Thanks.